Welcome to stockmarketfunding.com. I showed the Nasdaq chart. Now I'm showing the Nasdaq 100. But here's what I'm showing. I'm going to let you know now. This is Stock Market Funding. This is a Nasdaq 100 May $2,000 call. And the Nasdaq 100 made a high, 52-week high of 2044. And traders were asking me, and this is the put option. Okay, you can see where the high was here. So let me explain something. Why did, and this is a 2000 put option, both the same strike prices. The reason why this put option fell from $70 on a weekly level clear down to $34.80. It fell over $35. But why did this fall $35 and this one here, the 2000 put only gained a weekly move of, let me get down here. The weekly move was $15 to whatever it was here, 34 and some change, 41.80. But notice that the weekly move here in the put was 71.98 and the low was 32.80. So this one went much lower in value, lost all the premium based on the fact that it was $44 above the 2000 strike price on the call. That's this one here. So you know. And that's why this one gained more, lost more premium than this one, which is a 2000 put on Nasdaq 100, which is this one right here. Only it had a low of 16 to 35. It had a big move, but it didn't get near the value because it's not below the, when it falls below 2000, this value is going to go screaming higher. Whether it was an option on an equity, it's all the same. What the pro traders are taught here is if you look at both the weekly chart, and here it is right here. Here it is that the put was totally deflated. The call ran from this bottom all the way up to that inflated area. That meant that when we bought these and we wrote them up, but we started selling when we couldn't go higher. We started buying over here. And this didn't get near the value because it was $44 out of the money at the 2000 strike price. This was $44 in the money above the strike price. Premium came down hard. Now, when this falls below, the Nasdaq 100 closes below, you will start to see a big shot higher in this put premium like you did here. They took all the premium out. You'll be in the money. You were in the money here, 44 handles above the strike price. And when it came down, when it fell $44, in the money call, whether it's an index, an option trade, on an equity, it doesn't matter. Your premium's going to go down when you're in the money. When you're out of the money and you have a put, you don't get quite the value. You get some value, but not nearly the value until it gets below the strike prices here. And we are a buyer and a short seller based on the fact that this is totally, as a SMF market maker, this is totally deflated. This was the high up here, 160 freaking dollars. It was the high up here of $160. Here, the high from the bottom, these were $10. And they made a $60 move. If you had 10 contracts, 2-month strike price, you could have made 60,000 this way. Now that's inflated, and this is totally imbalanced, deflated. So when the market's correct, this side of the put side will go higher, and we'll cover it more in depth. I just want you to see, for the new traders that are in the school, is that they're both the same strike prices. Here they are. Here's the put option. That goes with this chart. Here is the Nasdaq 100. And what I'm going to do, and this is the call that lost the premium. Now, what I am going to do for the sake of the record is I'm going to do this. I'm going to show you on a weekly chart where the Nasdaq 100 is. Here it is. I'm just going to do it very quickly because I don't have much time on the video. But we're looking at, just like the Nasdaq comp reversed, and I did all the other indexes, is that we have that distribution bar. And I want to show you how overbought we are. 94.5. We have to come down. And we did. And we had big selling for the week. Bigger selling since that bottom low. This is the first big distribution week that we have had on the Nasdaq 100. Here we just had a little pullback, big deal, narrow range week, but we haven't had any real weekly distribution from when we went long, and we called the bottom here. This is the only distribution bar that we have. Now we're overbought here, we're declining here, and the thing about it is we made the lower low. Or we made the bigger, greater movement down. We had a counter trend, reversal trend. Thursday there was a big uptrend. Friday there was another big sell. This is the final weekly bar. We'll be updating our traders more. This is a training session. We have put trades on. This is the beginning of the reversal. The overbought right there is that anything that's overbought has to have a pullback, no matter what. Doesn't say that we're going into another bear market right away. I'm not saying that. What I'm saying is, like we always do, just like we told people over here at the beginning of the year that we shorted this market in the first part of January. This is how they started. That's a continuation. When we stopped going lower, weekly doji up bar, we went long. But this is the first distribution bar since that uptrend cycle. And basically that makes the put option a nice trade. Here it is. 2,000 put option. The low was 16, made a big move. 10 contracts, $16,000. You damn near made 16 grand or 15 grand, 12 grand on the trade. This is what it's about. In the SMF Pro Trading School, we teach people how to be risk managers on indexes. We teach you how to trade mathematical imbalances, overbought, put option, overbought, oversold calls and puts. Imbalance ratios are to be traded. Very sophisticated. Thank you for enjoying the videotape. Join the Stock Market Funding School. Learn how to be a pro.